commercial banks in India. Commercial banks are the institution which accepts deposits, provide business loans, and offer related services. Commercial banks provide a variety of deposit accounts such as current account, savings account, and time deposits. These institutions are run to make profit. Commercial banking, also known as business banking. Commercial banks are basically divided into scheduled commercial banks and unscheduled commercial banks. In this lesson, we cover the functional essence of commercial banks. It follows from the previous slide that after studying this lesson, you should be able to know the definition of commercial bank, understand the strength, weakness, opportunities, and threats of commercial banks, understand the different challenges for commercial banks, define the role of commercial banks, understand the different types of commercial banks, know about Negotiable Instruments Act. The Banking Regulation Act 1949 defines banking as accepting for the purpose of lending or investment of deposits of money from the public, repayable on demand or otherwise, and withdrawal by check, draft order, or otherwise, and says that any company which transacts the business of banking is a banking company. Customer is a person whose money has been accepted on the footing that the banker will honor drawings up to the amount standing to his credit, irrespective of his connections being of short or long standing. Accordingly, a customer is one who has a deposit account irrespective of its debit or credit balance with the bank. Even an agreement to open an account makes one a customer. But one who has any other transactions or business only but no account with the bank cannot be called its customer. Then there are various relationships. When a bank accepts deposits, it becomes debtor and the depositor or creditor irrespective of the fact the bank pays interest or not. Banks may also act as trustee when a person having no account with the bank deposits money with instruction to retain it till further instruction. The customer instructs a bank to debit his account or deposit an amount for utilizing it for a specific purpose or for remitting to other branch or bank or manages properties of its customer. When the banker accepts bills, etc. for collection on behalf of his customer, he acts as an agent and the constituents. When a bank accepts articles for safe custody, its legal position is that of a bailee, who is duty-bound to take as much care of the goods bailed to him as a man of ordinary prudence would, under similar circumstances, take of his own similar goods. On hiring out of locker, bank becomes lessor and the hirer a lessee, and the relationship is that of landlord and tenant. The basic functions of the commercial banks comprise of transfer of funds, acceptance of deposits, and then offering those deposits as loans for different purposes and to different sectors. But now the expanding business activities of the banks have changed the bank's orientation from passive funds mobilizer to the active financial intermediary. The customers have become more demanding today. The transition from seller's market to buyer's market has compelled the bankers to understand the pulse and needs of the customers. Bankers today have no choice except to alter their product mix, delivery channels, and corporate structure to serve their functional role. The commercial banks in India offer a variety of products and services like investment advisory services, tax advisory services, cash management services, debit cards, ATM cards, credit cards, personal loans, education loans, housing loans, car loans, investment advisory services, and consumer durable loans. So, the customer orientation approach of the banks has given rise in retail banking. Retail banking includes designing delivery of customized products from both sides of the balance sheet. While various deposit products offered by the bank are assigned different names, the deposit products can be categorized broadly as demand deposits, saving deposits, term deposit, notice deposit, current account, and recurring deposits. A saving account may be opened by a properly introduced individual, singly or jointly, minors of the age of 10 years and above, and minors under natural or legal guardianship. A current account may be opened by individuals, singly or jointly, partnership firm, company, association, institution, trust, society, etc. Any individual or a minor of 10 years and above in his own name, otherwise under guardianship, HUF, a firm, a club, association, educational institution, municipality, panchayat, society, trust, etc. can open the recurring deposit account. With a view to ensuring a healthy loan portfolio, public sector banks have taken various steps to bring their policies and procedures in line with the changing scenario, which also aims at effective management and dispersal of credit risks, strengthening of pre-sanction appraisal, and post-sanction monitoring systems. All overdraft accounts are treated as current accounts. Normally, overdrafts are allowed against the bank's own deposits, government securities, approved shares and/or debentures of the company, life insurance policies, government supply bills, cash incentive and duty drawbacks, personal security, etc. A demand loan account is an advance for a fixed account and no debits to the account are made subsequent to the initial advance except for interest, insurance premium, and other sundry charges. Term loans are sanctioned for acquisition of fixed assets like land, building, plant or machinery, office equipment, furniture fixture, etc. for purchase of transport vehicles and other vehicles, for purchase of agricultural equipment, machinery, and other movable assets. Cash credit account is a drawing account against credit granted by the bank and is operated in exactly the same way as a current account on which an overdraft has been sanctioned. Advances against inland bills are sanctioned in the form of limits for purchase of bills or discount of bills or bills sent for collection advance against bills sent for collection to borrowers for their genuine trade transactions. Packing credit is an advance given to an exporter who holds a importer or exporter code number assigned to him by the Directorate General of Foreign Trade. Letter of credit is issued by the bank at the request of its customer in favor of a third party informing him that the bank undertakes to accept the bills drawn on its customers up to the amount stated in the LC subject to the fulfillment of the conditions stipulated therein. Guarantee is a contract to execute the promise or discharge the liability of a third person in case of his default. A mortgage of immovable property is taken either as a primary security or as an additional or collateral security for the bank's advances as may be provided in the sanction. The Reserve Bank of India, vide its circular dated 07-10-1999, came out with guidelines on risk management system in banks. The Basel Committee on Banking Supervision as well as the Reserve Bank of India have defined operational risk as the risk of loss resulting from inadequate or failed internal processes, people, and systems or from external events. This definition includes legal risk but excludes strategic and reputation risk. Legal risk includes but not limited to exposure to fines, penalties, punitive damages resulting from supervisory actions as well as private settlements. Operational risk policy shall create the basis for the management and control for the operational risk. The table on the screen shows us the framework of the operation risk management followed by banks. Now let us have a look on the strengths, weaknesses, opportunities and threats of Indian commercial banking system. In the table shown here, it gives us a detailed explanation of the same. Indian commercial banks are facing a lot of challenges due to economic changes. As you can see, the major challenges that the Indian commercial banks face are deregulation, new rules, efficiency, diffuse customer loyalty, misaligned mindset, competency gap, and increased competition. Continuous deregulation has made the banking market extremely competitive with greater autonomy, operational flexibility, and decontrolled interest rates, and liberalized norms for foreign exchange. Marketplace has been redefined with new rules of the game. Banks are transforming to universal banking, adding new channels with lucrative pricing and freebies to offer. This in turn has made it necessary to look for efficiencies in the business. Banks need to access low-cost funds and simultaneously improve the efficiency. This will definitely impact customer preferences as they are bound to react to the value-added offerings. Customers have become more demanding and the loyalties are diffused. There are multiple choices. The wallet share is reduced per bank with demand on flexibility and customization. These changes are creating challenges as employees are made to adapt to changing conditions. There is resistance to change from employees and the seller market mindset is yet to be changed, coupled with the fear of uncertainty and control orientation. Acceptance of technology is slowly creeping in, but the utilization is not maximized. Placing the right skill at the right place will determine success. The competency gap needs to be addressed simultaneously, otherwise there will be missed opportunities. Indian banks have to face tough competition due to the entry of foreign banks and new private Indian banks. The Negotiable Instruments Act was passed in 1881. Some provisions of the Act have become redundant due to passage of time, change in methods of doing business, and technology changes. However, the basic principles of the Act are still valid and the Act has stood the test of time. Let us understand some of the main elements of the Act. A negotiable instrument means a promissory note, bill of exchange, or check payable either to order or to bearer. A promissory note is an instrument in writing containing an unconditional undertaking signed by the maker to pay a certain sum of money only to or to the order of a certain person or to the bearer of the instrument. A bill of exchange is an instrument in writing containing an unconditional order signed by the maker directing a certain person to pay a certain sum of money only to or to the order of a certain person or to the bearer of the instrument. The maker of a bill of exchange or check is called the drawer, and the person thereby directed to pay is called the drawee. Common characteristics of negotiable instruments include negotiability, writing and signature, money, title, notice, presumptions. Parties to a promissory note include maker and payee. Bill of exchange include drawer, drawee, and payee, and check include drawer, drawee, bank, and payee. Types of negotiable instrument include ambiguous instrument, bearer or order instruments, in-court stamped instrument, inland or foreign instruments, accommodation bills, demand or sight and usance bills, fictitious bills, clean and documentary bills, escrow bills, bills in sets, and coca. Endorsement is the signature of the maker or holder made with the object of negotiating or transferring, not as a maker of the instrument. Endorsee gets right of further negotiations if not otherwise restricted. A negotiable instrument can be dishonored by non-acceptance and non-payment. Negotiable Instruments Amendment and Miscellaneous Provisions Act 2002 has made amendments in the Negotiable Instruments Act 1881. Now let us check if we have understood the various concepts discussed in this lesson clearly. Term deposits are placed with the bank for a definite time period, although the customers are free to withdraw their deposit as per their requirements. Right or wrong? Right. Current account is opened in the name of two or more persons. Right or wrong? Wrong. That's joint account. All overdraft accounts are treated as current accounts. Right or wrong? Right. Before we end, let us briefly revise what we have studied till so far. Commercial banks in India are categorized into scheduled commercial banks and unscheduled commercial banks. The scheduled commercial banks have been listed under the second schedule of the Reserve Bank of India Act 1934. The public sector banks, private sector banks, and foreign banks come under scheduled bank category on the basis of government stakeholding. The basic functions of the commercial banks comprise of transfer of funds, acceptance of deposits, and then offering those deposits as loans for different purposes and to different sectors. But now the expanding business activities of banks have changed the bank's orientation from passive funds mobilizer to the active financial intermediary. Efficient management of loans and advances portfolio has assumed greater significance as it is the largest asset of the bank, having direct impact on its profitability. In the wake of the continued tightening of norms of income recognition, asset classification and provisioning, increased competition and emergence of new types of risks in the financial sector, it has become imperative that the credit functions are strengthened. RBI has also been emphasizing banks to evolve suitable guidelines for effective management and control of credit risks. Credit management is of crucial importance in banking activity. As commercial banks are mainly engaged with providing long-term loans, they have to be extra precautious in deciding the creditworthiness of their clients. Operation risk is new inclusion in the Basel Accord 2. The operation risk identification and measurement is still in an evolutionary stage as compared to the maturity that market and credit risk measurement have achieved.